Hello, everyone, and welcome to BFW 2401, week 4, part 3. Maybe this is the most important part among the 4 parts because we are talking about the Dupont model. It's 21 slides, and hopefully I can go over it in a reasonable time. So if you allow me to share, I will go just directly to the slides. Now, this is the this is my slides, and we are talking about the part 3, which is the analysis of bank performance. Actually, in this part, we will talk about the ROE model. So when we talk about the ROE model, we are also talking about the Dupont. We will give an example, and we will talk also about some other key ratios, which is actually specific to banking. Now, let's start with what we mean by the Dupont model or the Dupont model or the ROE model. So it uses return to shareholders as the starting point. So we will start with the return on equity, and then we will break that return on equity to separate ratios. And the return on equity will be function actually of those certain ratios. Now, in this case, actually, we can connect the risk and return, and we know where the ROE came from. So it's based on ratios. It brings plus detailed data to explain observed changes in financial ratios and look for linkages. It built actually very structured discussion when you look at how the whole process. It's not like, you know, the categories which we had before, which is one of the problem with the financial ratios. Everybody or every group of ratio is in separate islands, and you cannot actually, connect the dots of all those. So you will start with the ROE, return on equity. Now, if you talk about the ROE model or you talk about Dupont model, actually they are similar, very similar. Dupont is one of the biggest company in the world, 1935, and they have this model which they connect the return on equity, which is our final objective, to the other ratios. Now, just one thing before I go, this is a very important model. We borrow it from corporates and we use it in banking because it's actually help our purpose or achieve our goal of connecting the risk and the return. Because the risk and the return is obviously and clearly connected in banks. Give more risky loans, get more interest. Do risky trading, make more profits. Well, the more you can be more conservative, the more you decrease your risk, but you also decrease your return. So without further discussion in this issue, we'll discuss it here. So this is the Dupont model. We have the ROE, which is the net income over equity, total assets over equity. This is breaking down to the leverage multiplier. And the leverage multiplier actually measures major leverage and dividend policies, which is coming under the financing effectiveness. Actually, this is measure our capital. It measures our capital because we want to see how much the total assets to our capital. Of course, the lower the better, not the lower the better, but we don't want it to be very high. So the equity is just very less and we don't have a buffer. And we have then, this is the first stage, which is the ROE and the leverage, net income over total assets. This is measures the overall operating activities, efficiency, and this will be broken down to asset utilization, which measures the asset portfolio management, maximum of yields, which is the revenues over total assets. And this measures actually the effectiveness of cost control, which is the net income over the revenues. Now, please think, because the tutorial also reflects those questions. Think about the balance sheet. When you have the net interest income minus net interest expenses, this is one of our main operations. This is the core of the operations, which is actually reflecting the revenue. So the revenue is the net interest income and non-interest income. And non-interest income is coming from the trading. interest income are coming from the loan. Then we have interest expenses, which is the depositors, the payments to depositors. And we have non-interest expenses, which is, for example, if we issue bonds and we pay for the interest of the bonds. These parts, net interest income, coming from the operation, net interest income and non-interest income versus interest expenses and non-interest expenses actually reflect our operations. But then, and it is in this area. Then we go down there and look at the, after that, we will have something like gross profit, and then we will go to the admin expenses, and then we will go to the tax, and then the net income. Now, when we come here, before we go to the tax, and after we finish the non-interest income and non-interest revenue, actually we are coming to the net profit margin. Net profit margin is decreased by the admin expenses. If I'm doing very well here in terms of my revenues, and non-interest income and non-interest expenses, and I'm decreasing also my expenses of the operations, which is interest expenses and non-interest expenses, but I am high here, which means there is a problem. My admin expenses is high, and this is why the net income is dropping. It's not because of my operations, but because of my management and the expenses inside. So as you can see, every one of those are looking for different measure, which means if I put it here, this is how it looks from the beginning. I can put this here and this here. I can put this here. Coming to here, and this is coming to here. And I told you this is the first stage. Now I want to break this again, and actually breaking this again is very important, because the model, the ROE model is just this one. ROE is average multiplier times the ROA. But the ROA now is the one that is broken down to this item and to this item. And this is why we are saying now when we want to analyze this one, we have to analyze, every part here until we reach, which means now we don't actually analyze the ROE, but we are analyzing the AU and PM when we take the ROE. So just in this stage, to explain to you, if you look at here, actually, it's a capital risk because we are talking about equity. I can decrease the equity here and has a less capital and increase this part. And here, I can actually increase the revenues because this is the asset utilization, increase the revenues by giving more loans, risky loans, and then increase it to the total asset and increase this ratio. And when I increase this ratio, of course, I will increase the total asset. Here, I can even decrease the, this is not the revenue, sorry. This is the net income over revenues. Net income over revenues here. So so here actually I can decrease this. I can decrease very important type of expenses, to increase this part. Maybe I decrease the salaries, or or fire the top management, or do all these things to decrease this one. But this will create in the future some type of operating risk, because I don't have skilled people here, or I don't spend in technology, or I don't maintain my systems, or I don't, all those expenses which I need. Therefore, it's very important to know where this guy come from. It has to come from this and this. And when we take it to banking, this actually reflects our capital risk, and this reflects our credit risk, and this reflects our operational risk. Look at this more clearly. As you can see, the ROE, as I explained it here, is reflecting the credit risk, because I can increase the revenue, and maybe I increase the revenue with bad loans. So when the ROE increasing, suddenly I have to know why it was increased. I have to look at this and go and check all the numbers that led to the increase of ROE. Maybe everything is just fine, but I have to put the questions to understand why, especially when there is a certain hike or jump and the asset. So as you can see, the ROE reflecting the return, which is actually a function of the credit risk and capital risk, and also actually operational risk. So if you can look at it, mathematically, you can say the total assets over the equity. And total assets is actually equity plus debt. This is the total liabilities, which is actual to the total assets. Then we have 1 plus debt. If I can put 1 plus debt over equity. So I can take the equity with the equity and bring the debt over the equity. So this is actually the capital risk, if you look at it mathematically. So let me go now to the next slide. So to do I wish you understand this one. We have some example here, and we use data we will use some example, hypothetical example, and maybe explain it better. So now to do the financial analysis for the ROE, you have to collect absolute data, which means all this data for the ROA, ROO, ROE, and ROA, and leverage rate multiplier. We have to calculate the ratios, identify initial meanings of each ratio, look for linkages, consider the key ratios. Because look, I just put this here. When I told you I can increase the revenues, I can increase here the cash flow. But I can increase it on the expenses of, because the price, if you look at market value of my bank, I can increase the cash flow. And also, if this increase of cash flow will increase the risk, which is the I, the price will move according to this movement in I and cash flow. So this is why when we say we have to look at linkages, is because this is accounting number, it's not a market numbers. When we say the ROE is increasing, we want to see why it was increasing. Because if you reflect it on the market, area, there will be a share price, and share price is actually evaluated by investors who can see everything. If they are really worried that the bank is taking credit risk, they will increase the I, which is the return, the discount return for any investment with you, and this will drop your price. We don't see it in the accounting numbers when we do the ROE, but the market will reflect it. But this is how actually the process would be reflected in the market. It's cash flow and against risks. So then to complete the performance assessment, look for a share market data, credit ratings, non-financial indicators, and other measures of performance. And I think we have talked about this before, and we talked about the validation. So if you validate, if you want, because accounting numbers will tell me accounting numbers, but we want to see what the externals are saying. If I'm making very high ROE, I should have high rating and have share market data. As I told you, if you look at this number. If the market data, if the market price is going down and the ROE is going up, something wrong. Maybe these numbers are cooked, or maybe I'm using a very extreme accounting policies that are affecting the bottom line, which is the net income completely. And then we have to calculate the growth rates and market share to see how whether we are really increasing and ROE is increased. Look at this hypothetical example. This is just a financial statement, and it's for 2 years. And the income statement, balance sheet and income statement for 2 years. We can actually, according to this data, complete our calculation for the Dupont. Now, this is the calculation. We can calculate the revenues, which is interest revenues, but non-interest income, which is this one actually. It's easy, it's not a big deal. This is the interest income. This is the net interest income. I mean, if you calculate for 2019, I mean, it's a very straightforward calculation, very straightforward numbers. We can calculate the net income, which is this one. It's just the bottom line. This is the net income for the 2 years. It's just reflected here. Total assets, we take average of 2 years. And this is what we do in banking. Equity, we took average. But the problem in this example, I have only 2 years, 2019. I can take for 2020 and 2019 and make an average. But when I come and compare to 2019, I need 2018. I didn't bring 2018, so please take just the year end, which is the year end for 2019 and 2020. But to let you know in this stage, when we do the calculation, actually we take an average of 2 years. Anyways, I take using 2019 data, we get these numbers, and we started now to do what? We started to compare with the industry, which is the peers. And we see, look, actually in 2019, we are doing well comparing to the industry in terms of everything, which is this bank probably has maybe something wrong because they are doing well in the ROE. We are in the leverage multiplier is even less. We have less capital, less expenses, and ROA is also higher, and asset utilization is even much higher. But when you come to the net margin, they are higher than us, which means there is something there. Maybe the expenses after the net gross profit, after we get the income from the operations, which is the net interest income plus non-interest income, and minus it from interest expenses and non-interest expenses. When we started to decrease get the admin expenses, maybe that number is huge. And this is why the net income has eaten all these, not all, but make a big impact comparing to the industry. This is just one of the questions that you have to ask yourself. So as you can see here, I think I have explained it. When you get the numbers, this is when we compare to we have to ask question, why? So we know that our ROE is high, but to answer why the ROE is high, we have to ask why the multiple, we have to ask what happened to the leverage multiplier, the ROE, and the breakdown of the ROE, which is asset utilization, and the net income. I don't have the answers. You don't have the answers. Only if you are insider and you are analyzing this bank, you will have some answers. But in this stage, as we are studying this, we only raise questions. Maybe everything is just fine. Just we don't have enough information. But we need to do that. Okay, the other thing is, if you compare the peer, now the trend, you remember when we say a very valuable and a very meaningful interpretation of the data, we have to see how we are doing to the industry, which is the average. We want to see how we are doing in terms of the trend, which means our last year and the years before. And we want to compare with the targets. Here I bring only the trend and the trend and only the peers. So in terms of the 2019-20, we are doing well in 2020 actually. I don't know, maybe because of COVID. So we have 14.2 to 12.7. No, we are not doing it well. I mean, the leverage multiplier is improving. We have less capital. We have improved in the ROE and the asset utilization and the net margin. So again, we ask questions. Maybe we hired someone in 2020 and he come with very aggressive policies and infected these issues. So they can make an asset, they can increase actually the asset utilization by giving more loans. So maybe the question is, have the asset interest rate risen? So which means there is an interest rate increase in the market and we increase our interest rate to our customer. This is what makes our interest income higher. Or maybe the mix of the asset moves to higher credit risk, which means we started now to move to more risky loans that give more return, or maybe we are going in some risky derivative operations, speculations, whatever, that is increasing up our income. Or maybe has non-interest income increased. Maybe if it's from the trading, is it trading or from the loans, or maybe we move, as I told you, to different stage of operations where we take more risk and achieve more returns. Now, the net profit margin has actually decreased. So have the costs actually decreased? Have non-interest costs fallen? Or is it because of low taxes? This is very nice, and this is legitimate, questions. But maybe also we are decreasing a very important operation costs, which means will affect it doesn't affect us this year, but if I am going to, kick out all those senior management, very experienced people, skillful people, and replace it with very maybe young, active people, but don't have experience. Maybe I am, accumulating some type of operation risk, not for this year, for the years to come. So if I hired some, CEO last year and he come with all those policies, the numbers would show very, very great performance end of the year. But before I say whether he did very well or not did very well, he or she, then I have to look at all those issues. So I'm done with the ROE, and the ROE maybe most of the questions I have for you. I think an appendix, and I will upload it for you, and you can. I think I get it from the book. That appendix is only 2 pages or 3 pages. You can read it. We have other key ratios. Now, the other key ratios, it is ratios actually, maybe you see it for the first time, but it's actually related to banking. And by this stage, which is week 4, you already have some information about it. So we talk about bank efficiency. We'll talk about interest rate differential, and we talk about the risk measures. Now let's go to the first one, which is the bank efficiency. Bank efficiency, we have actually 3 ratios: operating income per employees, and we can have it in corporates or in banks, but actually we want this ratio to be higher. So we want the net operating income over the number of employees to be higher, so which means the contribution of every employee is high in the net operating income. So we need this, denominator to be less. We have cost to asset ratio, which is the operating expenses over the total assets, and we want this to be as less as we can. And we want the efficiency ratio, or the cost to income, so operating expenses to operating income. We want also this ratio to be very low. These 2, we want them very low. I mean, in a legitimate way. So the lower is the better here, the higher is the better. So those 2, the lower is the better. Then we have the net interest income, which is the difference between the interest we earn minus the interest we pay. And this is one of the interest differential, we call it, We have another ratio for interest differential, which is the percentage of interest spread, which means you take the interest earnings over the interest earning assets. What do you mean by interest earning assets? Earning asset means not all the assets, only the loans and our investments. Any assets that bring us an income, we call it earning asset. So all those fixed assets, all those other assets are not actually earning assets, so we don't bring them here. So we want to know how much interest we are earning on our investment, either in loans or in trading. This is what we mean by interest earning assets, which means how much we are doing in terms of the in our investment and our loan policies. Interest expenses, the same thing, how we are doing with our liabilities. So we want to measure the interest expenses based on how much we pay to depositors or how much to pay to the bondholders if we are issuing bonds. And then we have to look at the percentage of interest margin. So interest margin is interest earned minus interest expenses over the earning assets. And this is actually, so we have also three measures for interest expenses, and we want this, all of these ratios actually to be high, all of those to be high. The higher, the better. Okay. Now, this is our friend, and we have studied an interest rate risk, interest rate sensitive assets over risk sensitive liabilities will tell us something about the interest sensitivity. And I think we know that if the ratio is 1, that means risk sensitive assets equals risk sensitive liabilities. So I cannot tell you now in this stage whether interest is sensitive as whether this ratio should be better to be higher or to be lower or to be 1, because it's 1 means we have zero gap, but well, I cannot tell which is whether it's better to be high or low, because that will reflect the gap, and the gap, the net interest income will be impacted by the gap and the movement of the interest rate. So this is a relative thing, just a measure, but to see whether it's you want it higher or lower depends on the movement of the interest rate in the market. Now we have so many measures for credit risk, including this for the assignment, which I give you for the pre-class activity. So we have the net write-offs. This is the loans that we write them off over the assets. We have non-performing loans. We have the one in which I gave you the loan loss reserves or provisions over total assets. But this is one of the majors. So when we talk about credit risk, it's just a piece of those measures for credit risk. Now, liquid assets also, we can have liquid assets over total assets and liquid assets over total deposits. So when we move ahead and this class, and we will go to week 6 and 7 and 8, we will really talk about very, very modern, models for measuring liquidity risk and credit risk. This is the credit risk and the interest rate risk. So this is just a very, very basic measures, and you can just take it to give you some sense about the understanding of this risk. We understand the capital risk, which is the shareholders' funds over the assets. This is the capital ratio, actually. This is the capital ratio, which is the simple capital ratio. And this is the capital ratio according to Basel. So when we talk about qualifying capital, we are talking about Basel, which is the risk-weighted assets here. Risk-weighted assets, which I think I give you already in the pre-class activity. Sorry. And this is the just the simple ratio. This is equity over total assets. And finally, we have this off-balance sheet. Now, off-balance sheet, we have 2 measures. Of course, for this ratio, just to come back, it's very difficult to say. We want liquid assets to be high. We want this ratio to be high, but not very high, because if it is very high, it's an efficiency problem. Same thing when we talk to capital. We need it only to meet our risk, but it doesn't mean the higher the better. It just means that we have to have enough capital. Yeah, regulations will tell us how much, and actually our calculations at the bank will tell us how much. Because if you keep the whole money as capital, then you are very, very inefficient. Same thing, a course here of balance sheet, business of total balance sheet. Of course, it will be 5 times. In some countries, it's 10 times, 20 times. So the more you take out of this, it depends on how you control your risk. So again, I cannot tell you the lower the better or the higher the better. I just want to tell you it depends on how you manage your risks and how is your exposures. So, but this is actually 2 measures. And finally, we have very important fiscal measure, which called, value at risk. Now, value at risk is actually related to the market risk, which we will take in week 8. I think we have one problem. We will deal with it. We will talk about week 8 is only about value at risk. So value at risk is actually a statistical model, and this statistical model will bring the distribution of our assets, and we will see what is the area under the risk, and we call that bar. Don't worry about it. And this stage, we will be talking about it just to tell you that value of risk is using normal distributions and distribution and statistical approach to measure the risk based on the random behavior of the risk. I'm done for this part. Thank you very much. And I will see you in the first part. Bye-bye and thank you.